The opinions expressed are those of the host. The material is for informational purposes only. It does not constitute investment advice, and it is not intended as an endorsement for any specific investment. Visit crestmontpw.com for more details.
Welcome to the Ascent. This is Sam McGee. I'm the CEO and owner of Crestmont Private Wealth, and we have offices in Houston and Boerne, Texas, and we serve clients all over the United States. We are very excited about today's show because we're talking about everyone's favorite subject, which is market jitters. You know, what happens when markets go sideways or down, and the awful gut-wrenching feeling that you may feel in the pit of your stomach. But we're going to talk about it because it's important to recognize that's part of being an investor. And today we have Alec Walker, who's our EVP, and he is a CFP professional in our Houston office. Alec, welcome to the show.
Hey, Sam. Glad to be here. This is it's been an interesting, less than 30 days since we've kind of had the decline from the previous market peak. So happy to join in and talk about what's going on and how investors are reacting to this.
Yeah, today we're talking as it's Thursday, March 20th, 2025, but I feel like we could take this episode and we could apply this in 2026 or 2027, or we could go back to the financial crisis, or we could go back to 9/11, or we could go back to any event that happens in markets that causes markets to get jittery, for volatility to increase, or for corrections to happen. And that's what we're going to talk about today. We're going to talk about the fundamentals of what drives these things and how investors react to it and what you should and shouldn't do. So, Alec, get started a little bit on that. What is your perspective? We've been working together 11 years now. So what have you seen in your 11-year history of us working together through all those different jittery points?
Yeah, so essentially what's happened right now, a market correction, the S&P 500 has fallen 10% from its previous highs. This one has occurred rather quickly in less than a month, where it's fallen 10%, and investors are rightly a little spooked by that because many of our assets are tied to our 401ks and into the market, and when you see that loss in value, it can cause stress and fear. But historically, if we zoom out and go looking at a chart here all the way back to 1980, the market averages a 14% correction in a given year. So this 10% correction, it's a run-of-the-mill correction, though it can feel severe and aggressive. But despite those 14% corrections, the market has been positive in 34 of the last 45 years. So the odds are still stacked in investors' favor on the side of capitalism and growth. And what we've historically seen when we get to this point where fear starts to increase, pessimism starts to really increase, is investors want to make a significant change, and they want to get off the train from the plan that we've established. And that, in our experience, tends to be the worst time to make a significant change. Right now, you know, what's going on in the market, consumers are concerned. There's risks economically, there's risks in the job market. There's always going to be certain risks that make you want to change your plan. And historically, when that sentiment gets low and fear is at the highest, is actually when the markets have historically performed pretty well over the next 12 months, over the next year, because markets are forward-looking. That's why we've seen such a quick correction, as the market is pricing in some risks that investors tend to be slow to react to. And if we try to play catch-up, we end up missing out on those future returns, and that hurts. That can destroy wealth, as we always talk about with our clients.
Yeah, trying to time the market is exceptionally difficult, if not near impossible. And I think that is a big piece of our investment philosophy at Crestmont Private Wealth, is starting with a financial plan that makes sense for each individual client and with a risk tolerance that's really well understood, as well as your temperament as an investor, and then designing a investment program that has some adaptability, of course, for rebalancing or life changes or as you age, trying to get in or out of certain securities or sectors or trying to time a recession and trying to time the market, it's very difficult. That's, in my opinion, that's like trying to predict where's the next wreck going to be and at what time on Main Street in Boerne, or when is going to be the next lightning strike. So it doesn't make sense spending time on things that you can't control. It's a lot more important to spend time on things you can control, like filling your brain with education. And Alec, explain a little bit about how we educate our clients and maybe the listeners that aren't our clients to understand a little bit more about the behavioral side, and maybe explain a little bit about that red dot chart and describe it in detail, since this is radio and not visual, the red dot chart and how we take clients through that and what that tells us. What is it?
Yeah. So in terms of our education, obviously this podcast we're doing now, videos, newsletters, one-on-one meetings and educations with clients to let them know, hey, here's what you're invested in, and explaining from very basic levels to more advanced and sophisticated levels of what we're invested in and why. I think that's really important. Clients that have been with us over longer periods of time start to become really comfortable, understand our philosophy. And so when they see things on the news, they realize, hey, I know why I'm invested in this. That red dot chart, what it looks at is it shows a series of gray bars, the return of the S&P 500 going all the way back to 1980. As I mentioned earlier, positive in 34 of those previous 35 years. But below those red bars are these red dots, we call it the red dot chart, that shows the peak to trough. So those different corrections throughout the years. And I'm looking, you see some numbers here, a 20% correction, a 25% correction, a 7% correction. And just over the last handful of years, we've experienced 8% correction, a 10% correction. And within those 2 years where we had that pullback, the market ended up being up 24%, up 23% those last 2 years. And so to your point, Sam, on trying to time the market, as we sit where we are today, we're a little bit off from 10% lows. Could the market go down 10% from here? Yes. Could it go up 10% from here? Yes. Do we want to make a big gamble, a big bet on what's going to happen? No, we want to set the asset allocation up to that specific plan, to that specific client, to that even specific account, what objective that is, and make sure that it's calibrated in the right way to withstand either of those two outcomes and set up the highest probability of long-term success and growth going forward. Because we really don't know which way that the winds are going to blow, but we want to have our boats out there to be able to benefit when that growth does take place.
Yeah, and I think time is the biggest ally for really any investor. Time to recover as sentiment changes, as economic situations change and conditions change. But let's say you're older and you say, I don't have time. I'm about to retire and I need this money now. I think this is where asset location, as you alluded to, is so important. When you think about diversification, I think the public at large sometimes thinks diversification means just having large number of securities. It goes beyond that. It's about having stocks and bonds and different types of asset classes within those stocks and bonds. And going back to the pandemic, I specifically remember that stocks were way down. I remember that credit spreads had widened, so bonds as a whole were not doing very well, but treasuries were doing great initially. And so walk us through what we did for those retired clients in that situation when they were living off the portfolio and how asset location was so important.
Yeah. So diversified portfolio isn't just a portfolio of 100 stocks, because in a time like that, they were all down nearly. And so that's where you got to have different asset classes, bonds in particular. In that situation, we were pulling from just the fixed income, just the bond, to give those stocks time to recover. Luckily, during that time, they actually recovered rather quickly. In other periods of time, like 2022, it took a little bit longer. So we developed different cash flow and asset location strategies for our clients that are retired to withstand those bear markets, to be able to, you could pull up your portfolio one day and look at your stock portfolio. Maybe your stock portfolio is down 10 to 20%. But if you look at, hey, this is the bucket that I'm pulling from, this is what I'm living off of over the next 12, 18, 24 months, this bucket's doing really well. This is holding its value. It's giving the rest of my portfolio time to recover. Because even if you're retired and you're 60, 65, 70, we're still planning over a 20 to 30 year retirement time horizon. So there's very rare circumstances where you're never going to have some stocks in your portfolio, some volatility. It's just a matter of constructing it in the right way that makes sense for your plan and your risk tolerance.
Yeah, it's an interesting topic. And when we go through these rough patches in the market, when volatility increases, you start seeing or hearing from people that you normally may not hear from. And it could be in the barber shop and people are talking about the market, or it's all over the headlines, or it's on alerts on your phone. And so I think that what we've noticed, I know the last 26 years of being a professional, is markets get talked about a lot when things aren't going well. And when things are going well, it seems like a comfortably numb situation. I just expect things to keep going up and up, and that's just not the case. Investments have risk. If they didn't, then gosh, markets may not function. Yeah, it's a bit of an interesting dichotomy and you hear about markets a lot when things aren't going well, and it just lulls you to sleep as gains happen. And so I think there's a message in that. The message that I think of is, gosh, fear of loss or having losses is a very psychologically powerful problem for the investor, whereas the euphoria of gain isn't as powerful maybe for most people. Alec, in your experience being head of our financial planning, what have you seen in meetings during those bad, turbulent times? What helps people be put to ease?
What helps people the most is talking through, reiterating the education again on what we're invested in and why, and then bringing it back to the financial plan. Because when we run our financial planning forecast, we're factoring in well below average market outcomes as part of those probabilities. So we're factoring in times like this where markets are underperforming, and just being able to illustrate and show clients really two things. Hey, here's where your cash flow is coming from. Here's how that money's invested. And here's what your long-term plan still looks like. And to your point, Sam, I think you were touching on, again, the behavioral piece of what consumers fall into the trap of is buy when things are high and sell when things are low. Again, is we help our clients, as you always say, stay between the lines of fear and greed. We don't get too high when things are high. We don't get too low when things are low. And that's us being the co-pilot, being there with their clients at the same side of the table.
So, Alec, how would someone who wants to continue this conversation reach out to Crestmont? What would be the best way of doing that?
Yeah, you can reach out to us via my email, Alec, ALEC, at CrestmontPW.com, or at info@CrestmontPW.com to just set up an introductory call and a consultation. And I guess this the last thing I'll kind of leave clients with, a piece of our investment philosophy, is to get that compounding and earn money over the long term. It takes time. So patience is a virtue when it comes to investing as well.
That's good. Well, Alec, I think that's all we have time for today. Thank you for joining us. Alec Walker, EVP of Financial Planning with Crestmont Private Wealth. Today, we've been talking about behavioral finance and markets. I hope you've enjoyed the show. Have a great weekend, and God bless.